Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today from a location unbeknownst to all of us, with his head on backwards, doing a podcast from a remote island in the Pacific, it's Michael Becker. Michael, how are you?
Hey, Paul, I'm not sweating at 100 degrees like you, so doing better.
What a guy.
So, Michael, where are you today and what's going on?
We're in Hawaii for a few weeks, kind of working from here remote for a couple weeks, trying to avoid the great Texas summer. So looking a little better shape than you are today. So things are good.
Yeah, that's a good thing about being in real estate. You can operate your business with partners from any part in the world. Just have good communication lines and good telephones and good communication through Wi-Fi. You could operate any place. So congratulations to Michael, a well-deserved vacation in Kauai. So good for you. So on the podcast today, we have one of our friends that we've known for a long period of time that I think really is an expert in multifamily. He has a very diverse background, was a lawyer, got into multifamily, did a lot of B and C properties like a lot of us have, but he's brought his game to the next level. And I want you to spend some time with him. We've had him on the podcast before. He's going to talk a little bit about what he's done, maybe something that you guys can do. He's going to talk a little bit about what the atmosphere of multifamily is all about. He's going to talk a little bit about some of the things that he does outside of what his main job is. But I'm looking forward to spending some time right now with John Griggs with Presidium. John, how are you?
Hey, doing great. Thanks, Paul.
Thanks for being on and watching Michael with his head on backwards.
Absolutely, Mike. Always good to see you.
Casual Friday here.
That's right. Casual Friday. Let's throw over to Michael, and perhaps Michael's just going to ask what I would normally ask is, tell us a little bit about John Griggs.
Yeah, John and I have been buddies for a long time, played in running similar circles, played in similar spaces for many years. And John kind of pivoted to do a little bit more development in the recent years, where I've kind of stayed in acquisitions and operations. But John, maybe give a little quick background on yourself for those that are not familiar with you.
Sure. Been at this over 20 years now, which is kind of crazy. I grew up on the East Coast, went to college on the West Coast at Stanford, went to law school at Michigan, always thought I wanted to be a lawyer, started practicing law and didn't love it as much as I thought I would. So a buddy of mine from law school and I crossed this area, and I started to try to find ways to do something entrepreneurial. Started buying little apartment buildings in Phoenix in 2003, bought a bunch of fourplexes with our own money, thought it'd be a sleepy little investment. Next thing you know, Phoenix is ground zero for the housing bubble. And what a bubble it was. It was crazy. Our little sleepy assets doubled in value in 2 years. For no good reason. We raised rents like 10 or 15 bucks. We thought we got to get out of here. So we sold those, had a nice payday. And that was kind of the seed capital for what's now Presidium. So this is back in 2005. We quit our law jobs, set out to build out an operating company, started investing in Dallas and Houston and Austin. And between 2005 and 2017, bought and renovated about 20,000 apartment units. And this was like the golden age. I mean, this was textbook. Everything's going your way. Except for the great financial crisis, which was super scary. But that was like the MBA I never got. That was when you learn how to make a dollar out of 98 cents and operate in bad circumstances. That was actually a great education. Though, painful. We came out the other side and we're ready to rock. And, you're buying units for 30,000 a unit. It's just a wonderful time. And so we're buying stuff kind of throughout that golden age. And it was, rents were rising, interest rates were dropping. You could renovate for half what you can do it for now. And everything was kind of wind at your back. And then towards the end of that cycle, we just started to get sticker shock, honestly. It was sort of, the unit that we had paid 30,000 for went to 50, went to 70, now it's 100, now it's 120. And it was just kind of like too rich for our blood. So we did a couple things starting in like 17 and 18. One is we started a development company because you could build for a lot less than you could buy for. And so we leaned into that heavily, built about 7,000 units in Texas, but also in Florida, New Mexico, Georgia, kind of expanded our footprint. And then we sold about 80% of our multifamily portfolio, the existing value add stuff between 19 and 22. So that was, it wasn't that I thought the world was going to end. It's just like, geez, we execute the business plan, you raise rents. I can sell this for a 3 cap. I don't know what else I can do here. It just, I don't know how it gets better. So we did that. And then the last few years, we've been, just grinding through this. And, it's hard to get development deals out of the ground. We have some that are ready to go. We're actually going to start one in Atlanta in the next few months, which will be the first one in a couple of years. We have some others that are close to viability, and we'll do it if we can. But we've also leaned back in to buying again, and so we bought 3 Class A assets in the last 6 months. One here in DFW, one in Austin, one in Miami, and I just feel like, man, there's not that many times you can buy assets for 20, 30, 40% below what they used to be, below replacement cost. And the sentiment's so bad out there. It just feels like this is kind of the time to do it.
I've been kind of describing to a lot of people my daily emotional roller coasters. It's kind of like I'm bipolar all of a sudden. I'm not in reality, but like you got your problems you got to deal with on your day in, day out basis. But then you got to be optimistic and opportunistic and take advantage of what's going on in the marketplace. Because like you said, it's a moment in time. We haven't seen similar metrics in 15 years, probably 16 years since, 9, 10, 11, and then kind of the great rise that you kind of described earlier. How are you kind of dealing with that? I guess it's kind of a question for those that are kind of going through it. How are you dealing with your life, just compartmentalizing, this part of it, dealing with this issue, at the same time being optimistic and pushing forward?
Yeah, no, it's tough because we definitely have some assets that are, you got to fight through it with them, and you can't sell right now. You've got to kind of keep them going. The things I learned from the GFC, one is don't be over optimistic. It's human tendency to say, okay, we're going to get back to 98% occupancy. Rents are going to rise. We're not going to need that capital call. And if you communicate that to your stakeholders, they'll listen to you. And then when you kind of realize you need something like, more capital, they'll it's not a great conversation. So I just learned, from the last downturn is just be radically transparent with people. Tell them, look, this is a situation where we're going to have to fight through it. It's not all good news. And if, it's so antithetical to human nature, especially for all of us as entrepreneurs. We wake up, if we didn't wake up and think tomorrow is going to be better than today, we wouldn't be doing what we're doing. And so it's in our nature to be optimistic, but sometimes you got to kind of temper that with reality. But then you just got to lean in and look for opportunities and just keep staying in the game, even when transaction volume's low. Just keep talking to everybody you can, see what's out there. And when that pivot happens, you'll be primed for it, which is the goal.
Yeah. Can we talk a little bit about some of the properties that you have built? To set a picture, if you want to go on the Presidium website, you'll be blown away about the quality of the properties that you guys have built and developed over the last, say, 10 years or so. That you built stuff down in Austin where it was very difficult to hang out with all the city council people and
oh my gosh
and beg them to be able to build an apartment building of 200 or 300, 400 doors in their city,
right.
Or in Florida, trying to get stuff approved and deal with insurance down in Florida. Talk a little bit about some of the trials and tribulations that you've had to go being a developer and coming out of the ground with some of these properties.
Yeah, no, you're right. It's all difficult, whether it's value add or development, but there's definitely a different set of challenges. And like you mentioned, if you think you hate national politics, wait till you deal with local politics, because that's a lot of fun. And it ranges, right? There's places where, we have a property in the Northeast, and the town passed rent control, and it just makes it not viable. So we're sitting there with a piece of dirt, and there's some things we hope to be able to do, but that's difficult. And then kind of on the other end of the spectrum, you have folks that in sometimes affluent suburbs of places like DFW and places that you'd think are pro growth, where the local communities don't want apartments, and you can try and educate them and say, look, it's not. We're not building a C-class property. This is going to be $2,000 a month to live here. It's going to be where your teachers and firefighters going to live? Where are your kids going to live when they get out of college? They're not going to buy $1 million house next year. They're getting apartments. You need to constantly be selling kind of a lot of municipalities and that. So that's tough. I mean, it's just, and then some places want to layer in affordability, and I understand why, but you do that, and it just makes these things not viable. I mean, the goal really needs to be, if we want to have housing affordable for people, you make more of it. And I mean, frankly, that's kind of what we did in the last few years, and it is more affordable because there's a glut right now. So I can go on for days about this stuff.
That all makes sense. I mean, you talked about all your stakeholders when earlier, and being kind of transparent with, said that you bought 3 kind of existing deals. You're about to break ground on a new project in Atlanta, hopefully this year.
Yeah.
What, so conversations with equity kind of range all over. So you got the people that your current equity investors in your current projects that are varying degrees of good to, maybe some issues. You're talking to the new people that gave you capital to buy those 3 projects. I'm assuming were newer construction below replacement cost. And then you have kind of the older vintage value add. Are you even looking at that? And then what's kind of the appetite you're hearing on this kind of those different buckets of kind of segments of the market? What are the equity looking for? What's getting them bite off? What are those conversations like today?
No, 100%. And let me just want to revisit real quick before I get in trouble here. I do want to mention there are some municipalities that have been great to work with, like Kennesaw, Georgia, where we're starting, McKinney up here in DFW, where we're planning a gorgeous mixed use project. Have been really wonderful to work with. So there is a spectrum there. But back to your question on equity, it's obviously, we know it's tough out there. What I think the problem is that even though we're below replacement cost and we're down 30 or 40% in just, asset values, equity is demanding, and they really want to get to that mid-teens, high teens return. And it's hard to do if you're not underwriting cap rate compression. There hasn't been rent growth in a few years. So you've got to either have a deep value add, which is, and we are looking at those again, by the way. They keep pulling me back. I don't know, but they're just too much fun. But people are looking for higher yields, and because they can get yields for free that are actually pretty good right now. I mean, you can structure a bond portfolio and make $6 or $7, 6 or 7% for doing nothing. The stock market's been on a tear. You got daily liquidity, instant liquidity from that. So you're asking somebody to tie up their money for 3 to 5 years. It's a tough sell. I understand why. And I think the other thing that's challenging, and this is across asset classes, is there just has not been much return of capital from private vehicles in venture capital, in private equity, and certainly in real estate. So a lot of people that want to invest, they put out a bunch of money over the last 6 or 7 years, and they're not getting that return of capital. So and here they are looking at their stock portfolio and saying, hey, we're doing pretty well over here. And if I need money from this, I can get it and click a button and get it in 10 seconds. So those are some of the challenges. Equity wants private equity firms, the big funds are generally looking for higher yields, and they want nicer stuff. And it's hard to kind of put those together and get there.
So what will be the decision metrics for the group that's going to give you development capital on the deal in Atlanta? Why would they say yes when there's perception that the market you can buy below replacement costs today, not take the 2 years of building, another year to lease it up? So you got 3 years of risk here when you just buy below replacement costs. Why are they biting off on that?
Yeah, man, I should have you on my investor pitches. You got it down. No, I'm kidding. I mean, you make really good points, right? And you got to address all of those issues if you're going to be successful in getting equity. So in this case, we've redesigned the project to get costs down. We're putting in an affordable program with the local community there to get a tax abatement. We're doing a HUD loan. I mean, we're sort of using every bell and whistle we can to get this thing, and the cost per unit is going to be significantly less than the recent trade. You've got to engineer that now, or it's not even feasible.
And that's the biggest challenge. You're delivering in a market where there'll be no new supply, and
that's the
biggest, prettiest thing on the market at that time, right?
Exactly. I
mean, and then the deals that you bought recently that were kind of the newer stuff below replacement costs, obviously that's an attractive metric. Was there any other? What was the biggest hurdle Was it just that, hey, where's the bottom in rents? Where, we're underwriting negative revenue metrics for 12, 24 months, something like that? What were kind of
That,
challenges you had to overcome on those?
no, I mean that's right. It's basically the debt's not accretive, so you're going in and it's very thin cash yields at the outset. But all each of those three deals had a story too. I mean, there were a couple of them with some affordability features. One was sort of a partnership that needed to get restructured. I mean, there was some angle and interesting. I mean, what I think a lot of investors don't want to hear is, I won the auction, lucky me, and it's a good deal.
Right.
Sometimes those are really good deals, actually, but it's just the narrative has got to be that you found something that just no one else can find, and it's
That's a good point. Not to go it's on a side tangent too much, but like I'm seeing in the marketplace, we bought a marketed deal last year, and it was like a hell of a good deal in my opinion.
yeah,
It was well
yeah,
below replacement costs, and a lot of the equity partners that we talked to didn't like it because it was a marketed deal. And I'm just kind of thinking like, well, shit, if you buy something off market, you're paying a bigger price than you would on a marketed deal that got beat
it
up and then
does.
retraded and
Yeah,
kind of worked its way down. So this is kind of counterintuitive to me right now, but that's the similar feedback that I've been getting as well.
I agree with you though.
Um,
You're right. I mean, and buying a marketed deal is not easy. It's not like it's like less work. I mean, it's a lot of work.
and then you haven't sounds like you haven't pulled the trigger, but the siren song is calling you back. Like it's starting to me to kind of go back in time and go back to our roots and buy some 1980s 8-foot ceiling product.
Oh yeah, but they're not making
Is
it
there
like
any
that anymore.
is there any like metrics? So I've been giving that like a lot of thought. Like I've been looking at it, I've been touring it, I've been underwriting, I've been trying to get my head around it because much like you in a similar time frame, we didn't go to development, but we sold the workforce housing and started buying, kind of your 8A minus product around the same time you started going into development because the metrics just didn't make any darn sense to me at the time. But now they're starting to see it seem a little more attractive. It seems like it's very disparate out in the marketplace. There's a lot of like deals out there that are just overpriced, people that have too much debt on them. They can't sell below debt, and then the lenders aren't really willing to mark to current market yet. There's different types of lenders, some that are set up and prepared to be able to deal with kind of your loan to type lenders, like a lot of our competitors that also had a debt fund platform, or there's your banks that aren't set up to do this. Are there certain metrics or certain things that tell you it's time to buy a 1980s deal in Irving or Arlington or HEB? What are you kind of looking to give you confidence to pull the trigger?
Get back into that. Yeah, I mean, I think you've really just got to be able to know that you can, do whatever work you need to do. Really make sure you know your pricing on that stuff because it's more than it was several years ago, and have an exit plan because the truth is, I mean, that the capex that people put into these deals, it's not permanent. I mean, this is, every 5 years you got to go back and keep these things alive again. So you got to have a path to get out fairly quickly. And you're right. I mean, we've looked at a bunch of, kind of either buying with the lender or some sort of state of distress, and the lenders really are almost very few of them are willing to take a write down of the principal. And if the value of the assets below that debt, it's just really hard to get. You can't really transact on that. So you got to find the diamond in the rough that's actually it's worth a little bit more than the debt, and you can go in and work with the banks on those. But those are hard transactions to get done.
Looking back where you and Cross got into the business a while ago, and now you've taken the business to the next level by 10 times. Any advice looking back to some of these folks that perhaps are looking to get into apartment investing, apartment ownership? Tell me a little bit about, again, I just made another investment personally myself in an apartment building. So I continue to put money out there. Have I seen my portfolio fall a little bit in terms of value of properties that I've invested? Yes. But I'm definitely leaning in. These values have come down 20, 30, 40% on
Right.
some of these properties. I'm definitely leaning in so that I see this as the opportunity. What are you advising some of the people that are coming up to you, John, and say, what's your advice?
On the investment side, I think it is the opportunity. I mean, this is, for all the reasons you mentioned, down quite a bit, below replacement cost. And then I think the metric that I like the best, maybe, because it's not really quantitative, but it's just we're starting year 4 of this. I mean, that's a long time to be down, to be in a bad environment. And at some point, that investor sentiment, it just flips. And, I mean, the for reasons I don't know, it's psychology, I guess, but there will be that inflection point. And for folks who are trying to get in the business, I mean, this is a really hard time to start out in the business, but those are sometimes the best opportunities. And you can go in without any legacy issues, go in with fresh eyes, fresh capital, and make a name for yourself pretty quickly. If you can assemble capital in this environment and perform as an operator, you're going to have a really long runway, because once this thing turns around and the new boom starts, it could be another 6, 7, 8 year run. And so you get on the ground floor of that, man, that's a great way to do it.
Is there some lessons that I know, sure, like you sit in a dark room sometimes at night thinking about some decisions you made and maybe some things you would do differently, given the benefit of hindsight. And both of us, I don't think did anything super stupid. So there's a lot of guys maybe marginally stupid, but any kind of lessons you've taken away from where we sit now in the middle of 2025 versus what you would have done 4 years ago differently? I know you sold a bunch. I know you traded up. There any things that kind of really crystallize like these learning lessons, and then kind of comparing that to like 08, 09, when those lessons you learned? I'm sure you probably ignored some things that you probably wish you would have done differently that you learned the first time. You got that lesson twice now. Any thoughts like that?
It's funny because I think about what we did, and kind of in the last few years, and knowing what I know now, I would have sold everything and I wouldn't have kept leaning into development, because it's, we've got some projects that are, I mean, they're sort of stranded a little bit right there. We own the land, we've designed them. I've got a nice line item on my balance sheet for architectural plans if anybody wants to buy them from me. But I'm kidding, obviously. But and I probably would have been less aggressive on doing that. But there's no problems that we can't solve. It's going to take time, and we'll eventually build all those things. But it's not going to be this year. It's just I think you sort of knew at the top. It just felt like things were too easy, and I guess just trust your instincts on those things, because they are right. That being said, I mean, it felt very bubbly. I mean, it felt like a kind of a crazy boom time in like 2016, 2017 as well. And if you had stopped acting, being a participant, then you would left a lot of money on the table. So I think there's almost like a dollar cost averaging to this whole thing, where you be prudent, you kind of plan for worst case. What happens if rates go up? What happens if occupancies come down? You give yourself that cushion, and if things beyond your control happen, you'll at least be able to get through it. But I think it's just really important to just have that underwriting discipline to know that, to have kind of multiple paths to victory, even if it takes longer.
Talk a little bit about, we've talked about this before, a new development these days, amenities mean everything. And there was an amenity war out there. Who had the best things on the properties?
Yeah.
If you're still building stuff these days, give me one or two unbelievable amenities that you're seeing on your properties these days, or you're thinking about putting in?
Yeah, I'll tell you what, here's one that's interesting. Podcast rooms. We have little podcast suites, and for people, they're good for Zoom and other things where you have a lot of people working at home. That's actually those get a lot of use. Honestly, I think it was an arms race, and it got a little ahead of itself. So we're actually, on some of our newer projects, gonna downsize the common area a little bit. I mean, you just get to a point where people absolutely need a swimming pool in a hot climate like this. They need a fitness center. Some of the other stuff is a little more marginal, and they're not, you can kind of get by without it. But something, a couple cool things that people aren't doing, that's always good. I mean, like the podcast room's always kind of a head turner and gets people's attention.
Got it. Any other kind of thoughts on kind of going forward as we wrap the podcast up? What are you kind of foreseeing the rest of this year? We're halfway through the year.
Yeah,
what are you kind of predicting for the rest of 25, and then kind of what are you seeing 26, 27, and when should we sell everything the next time, I guess, if you know that one?
I know. I think there's a lot of reasons why things are going to get better. If there's one, the only stat that you can reliably count on is future stat is supply and deliveries. And because we know that, because if something's not under construction now, it's not going to get delivered for 2 years. So we know for a fact there's going to be a huge drop off in supply in all these wonderful markets that we're in that got ahead of themselves. And that's going to start happening here in the next 6 months. That's happening. The other thing is this renter generation that's moving out of their parents' houses. They're actually pretty well heeled. I mean, the kind of rent to income ratios are better than people think, and so that's a good tailwind too. I think there's going to be some good things happening. I don't know what's going to happen with interest rates. I'm not planning for any major changes one way or the other, but some of these other things are good. And so at Presidium, we're leaning into buying more, both Class A, below replacement cost stuff and probably some value add. And then I'm a partner in an opportunity fund as well called Deloach Capital, where we invest with other operators and developers, raising fund 3 for that and really targeting distress, whether it's, a distressed property, a situation where a buyer maybe needs some capital very quickly at the end of a transaction to buy a distressed property, or just partnerships that need kind of recapitalization in some way. So we've been very active in that.
Contact your group? How could they participate with you on that?
Yeah. So, I mean, the easiest way to get in touch with me at Presidium is just go to presidiumre.com. There's a button that says invest with us. You just click on that. At Deloach Capital, it's the same thing. You can go to that website and there will be a contact page there. It's Deloach, Deloache capital.com. And we're out raising capital for Fund 3. I think, again, it's just there's so much negativity in this market and there's such a negative feedback loop with people that have invested for years. I mean, they were used to doubling their money every 2 years. Now they're just getting under siege with capital calls and bad news and crystallizations that aren't so good. But you've got to kind of look past that. And, when times are the worst and people don't want to buy this stuff, that's when you kind of want to lean in. And so it's hard now, but this is the time to plan for the next boom.
A lot of people always look to people that have done it before, and you and Cross have been hugely successful. What are you reading these days in apartment education, and who are you listening to, or what should people be listening to or watching that you're watching that could help other people?
Yeah, I mean, well, we'll start with the Old Capital podcast. I mean, that's you have to listen to that.
There you go. Thank you, John.
There you go. No, of course, a lot of stuff. There's obviously just the broader economic business magazines. I mean, whether in the Wall Street Journal, The Economist, Financial Times, all that stuff. But podcasts are pretty good. I mean, the Walker podcast is a good one as well. Jay Parsons has a great podcast. I mean, these are, you think about podcasts like yours and those guys. I mean, the level of granularity that you can, the information you can get about slices of the multifamily business, it's pretty amazing. And you just have to kind of keep listening to these things. And going to conferences is important, and just talking to other investors, talking to other participants, other operators. I mean, Becker and I have known each other forever and are buds. One of the coolest things about, I don't think this is true in every city. I think in Dallas, the community of owners and operators is generally pretty cohesive and collaborative, and a lot of us are friends and hang out together, and and share information. It's really kind of a positive.
Is that not your experience in other markets? I mean, or you just play in Texas and everyone's real friendly here?
I don't know. I mean, I kind of feel like in the Southeast as well. I think, definitely, I know people who do this in New York City and Los Angeles. It's not the same. I mean, part of it is just that, it's been good times here for, most of the last 20 years. So that helps. But there's just kind of a friendlier vibe here. It's good.
No, he's right. I mean, you go to these networking events, broker boondoggles, et cetera. You get to know and meet your competitors or people that you're either buying or selling from or to, and it just seems to become, a kinship, a friendship throughout the years with John and, many of our other peers in the marketplace that we, friendly compete against. And it's been kind of one of the things I didn't realize would be part of the industry when I got into it, not coming from money or background or didn't grow up into it, had to learn the hard way like John has. And that was kind of an interesting aspect to see how everyone's kind of friendly and try to, generally help each other out along the way. Got to keep your secrets close when you don't have a deal tied up. But
right.
Besides that, I think, once you have control of the deal, I think everyone's pretty willing and able to help each other out.
Now, Mike, when you get together with John, does John bring over a bottle or two from his winery that you guys just sit around and at the table and share a little bit of the
I've not had the Griggs wine yet, so
I need to fix that.
So let's talk a little bit about this. John, again, him and Cross are some of the nicest guys in this multifamily business. And again, it is a business, but it's it's where everybody, again, I agree with Mark. It's with Mike, it's a huge collaboration, but having a glass of wine, sitting down with friends is a big deal. Can you talk a little bit about Tres Colline and tell us a little bit about and how you guys got going in that business?
This is great. So a good friend of mine, Frank Bush, who actually is also my partner in Deloach Capital, the vehicle I mentioned. He and I have been good buddies for a long time too. He sold his title company in about 5 years ago and always wanted to get in the wine business. I told him one day I'm going up to Portland, Oregon. This is right at the end of COVID to meet with some investors and some folks. He said, "Hey, wait a second. Tack on a day. Let's go to the Willamette Valley. I want to get in the wine business. Let's check it out." So we go up there, we cruise around. So we should get something up here. This is a good time to get in the wine business. I don't know. Next thing I know, 6 months later, he's got 40 acres, 11 planted. There's a nice 3,000 square foot house on it. And we bought it in 2021. It's a gorgeous retreat. It's about an hour from Portland, Oregon. And it is, in the summer, it's just exactly what you want. It's 75 and sunny and dry and wonderful. And we started out selling grapes to a couple other winemakers, then hired a winemaker of our own who is renowned in the industry, has made wine for Flanor, for Beaufrere, some of the other big names up there, and started bottling our own stuff. So we make about 700 cases of Pinot Noir and Chardonnay and Rosé. So Tres Colline, Tres is 3 because it's 3 partners, me, Cross, and Frank. And the nod to Spanish from Texas. Colline means hill in French, and that's kind of a nod to Burgundy, which is our wine is sort of Burgundian style. So TresColline.com. All right, that's the last pitch I'm going to make here for a website, but go buy some Pinot Noir. It's delicious.
Let's get back to Michael. Michael.
Yeah, I do like Willamette Valley Pinot, so I'll look for a bottle here sometime soon, John. So we do appreciate you coming on. I don't want to take too much more of your time. I got to get back to the beach and
seriously,
summer vacation here, but definitely appreciate it. If anyone wants to find out information, just presidiumre.com, capital.
presidiumre.com, and then deloachcapital.com. Yep.
Great. John, thanks so much, Paul.
All right. Thank you, John Griggs. We certainly do appreciate it. Michael Becker, get back to the beach, please.
Back to the beach.
All right.
You guys are the best.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.